Low interest rates for a long time could have a drastic impact on your retirement. We've been talking about how different investments might react very poorly or potentially very positively in a low interest rate, potentially high inflation rate environment. This week, we're going to continue talking about investments. We're going to touch on one of my favorites. Welcome back. I'm Telton Hall, Certified Financial Planner at Advanced Financial Planning in Cedar City, Utah, where our team, we help upper middle class and affluent families accomplish their secure retirement income goals. We're in the middle of a dive into index allocations with the goal to help you understand how different types of allocations, they might benefit or they might get beat up by an extended low interest rate environment. Remember, of course, we're not saying whether these approaches are right or wrong for you. We won't know that until we have a conversation with you to determine what's really in your best interest. But we will try to give you some helpful education to help you avoid costly mistakes. The kind of mistakes that you certainly don't mean to make, but you just don't know what you don't know, and your retirement pays the price. So today, let's talk about one of my favorite allocations to an investment portfolio when it is appropriately correlated to an actual retirement income plan. I am talking about real estate. Now, I have no problem with local real estate, like rentals or commercial properties. I like all of that. Those types of investments have their pros and they have their cons, just like any investment. But I have so many people that come to me and they say, I'm done with rentals. I'm so sick of managing my property. Or worse, I'm so sick of managing my manager who's supposed to be managing my property and I'm paying them to do it. Now, real estate has been good to them, but they're kind of tired of it. They want something that's truly passive. We discuss a lot of options, but one investment that we'll talk about today, we'll really take a closer peek at today, is called publicly traded real estate. You can buy and sell real estate in a private deal. For like, I bought a piece of raw land with some water rights recently. It took about 3 months to pull it all together, close the deal. That's local private real estate. But I want to spend a minute today teaching you about publicly traded real estate, meaning, and this is important, this real estate, it's totally liquid and accessible and available any given day that the stock and bond markets are open. You can buy it or you can liquidate it. There's no rental contract. You don't have to sell it and then do due diligence and close through a title company or have a real estate agent agreement. What I'm talking about trades just like a mutual fund or an exchange traded fund. Any given day, the markets are open. So a major perk is that it's liquid and it's totally passive. Now that comes with the reality that you can see its value fluctuate daily. If you can sell it daily, then you see its value daily. In reality, local private real estate, it fluctuates in value too. You just don't see it on your computer screen ticking throughout the day. I want to take a moment to address this. Keep in mind, I like local real estate. I have publicly traded real estate and I have local real estate. I like them both. But I don't like it when the benefits of local real estate get misrepresented, like they do all the time. I could never in good conscience just throw out these half-baked examples of returns that real estate folks do, and they're just so cavalier about it. The first one that comes to my mind a few years ago, I'm talking to a guy who does real estate. I like him, we're friends now. But he was saying that he hated anything that traded on the market. He had worked with a different financial advisor a few years before. He wasn't happy, and now he was talking to me. The other guy had helped him get a mutual fund for like $3,000 a couple years before. And it had lost money, and so he cashed it out, and he'd gotten like $2,800 or $2,900 or something back from it. So in his mind, it was this big waste of money to use publicly traded investments. He said he only liked to have, he said, I like something real that, I could go kick the tires, is the way that he put it. I'm totally fine with that. I can still help him maximize his retirement income plan and make smart decisions. But here's the kicker. Then he tells me, listen, I bought a piece of real estate for $35,000, and now I'm getting offers for over $350,000. There's nothing that you can do like that. I thought to myself, wow, sounds pretty impressive. Wowzers. That's pretty doggone good. Now I'm a little more pessimistic, but at that moment, he caught me. I was truly curious. I mean, personally, I would make sure that I had all my facts lined up before I made a statement like that. But I was sincerely curious. I wanted to understand the details, so I asked, so you've never lost money on it? No, he told me. I'm like, wow, how long did you hold it? Because it sounds like you're flipping it after a year or two. And he said, oh, I bought it in 1979. So I'm like, that's good. And every year it kept going up in value? Oh yeah, he assured me. And so then I was really interested. What about during the 80s? There's that whole recessionary period. He goes, are you kidding? He said, nobody would have paid anything for it right then. Nobody had any money. So that's what he told me. I'm like, oh, okay. So then it did go down in value if you had needed to sell it, I clarified. He goes, well, I wasn't going to sell it at a loss, so no, I didn't lose money on it at all. I love it. It's a good mentality. And so you bought it for $35,000 and you didn't have to put any other money into it other than, pay your property taxes each year. And he goes, well, I got a zone change and I built a duplex on it. So I'm like, okay, how much did that cost? And it must have been a while ago because it cost him like $120,000. So hopefully he's been getting rent on it for a while. So at this point, I'm like, okay, I got it. This is this is fascinating to me. So what real estate folks will say is that a $35,000 property turned into a $350,000 gold mine that never went down in value, when it's actually an asset that did fluctuate in value if you had wanted or needed to sell it, and especially down in value during recessionary time periods. And it actually cost at least $35,000 plus the $120,000 to build on. So let's just say it's a $155,000 investment that turned into $350,000 over 38 or 39 years. Just simple math. That's around a 2% per year rate of return. Plus he's getting some rent along the way. Now let's compare that to liquid publicly traded real estate, typically referred to as a real estate investment trust. People shorten it to REIT. Sometimes they'll call it a REIT. We'll take a deeper dive in a minute, but here's a super generic, just real estate investment trust graph over about that same time frame. It's not a perfect comparison, but when you see the difference, it doesn't have to be a perfect comparison. If $100 on this chart turns into $7,000, then $155,000 that this guy put into his real estate turns into $10 million. Obviously, we don't know what the next 30 years will bring, and you can see that the values fluctuate absolutely. You're going to have to take the same, well, I'm not going to sell at a loss type of mentality, But even selling in the 2008 drop would have been $1.5 million if you had started with 155,000 versus 350,000 or so that he could have sold his property for back a couple of years ago. So let me reiterate. I like local real estate, I use it, but let's be real about its pros and its cons, and let's not underestimate utilizing a REIT index. With that, let me teach you a little bit about REIT indexes and the funds that track the indexes in general. They will usually pay some type of dividend. That makes sense because often the underlying properties will be having some kind of rent as a rule of thumb, and then that gets passed through to the owners of the fund, just like rent gets passed through to the owner of a local duplex. They will either be domestic, which is US properties, or international properties, or both, which is called a global REIT. They will often fall into commercial, multifamily, industrial, retail properties, healthcare properties, just to give you some examples of how they get segregated. So let's look at indices. Dow Jones Real Estate, iShares Real Estate, ProShares Real Estate. These are all funds that track real estate indices. Let's spend a minute looking at the Dow Jones Global Real Estate because it'll give us a framework. It'll give us a big picture. For example, here is the sector breakdown for the Dow Jones Global Real Estate. It has healthcare and hotels and industrials and retail and residential, and then some specialized buildings that are specifically designed for certain entities like corporations or governments. One takeaway from this is that you can find a fund that just does industrial, or a fund that just does residential, and there are certainly seasons for those segments. Then keep in mind that an individual REIT, it's going to be composed of individual companies that hold a lot of real estate. That individual company is often called a REIT just by itself, so you can buy an individual trader REIT or a fund of REITs or an index fund that might have a bunch of individual REITs as part of that, or even it might have funds of REITs as well. So there's ways, if you want it, to access the benefits of diversification, or you can really dial in and focus. The next aspect we should consider is diversification by country. You may want to focus on just one segment of the whole globe, or maybe you want to dial into just one country. Or in that case, as you can see from this chart, a global index takes a global approach. So there's 20 different countries listed here. One really thing to notice with this index is the way that it's configured. The US is still far and away the largest player. So that can make sense for a lot of reasons, but let's say that you wanted to participate in emerging market potential real estate gains. This REIT index wouldn't really do it for you. But there are some that could. So the publicly traded, totally liquid space, it's certainly worth understanding and potentially including in your retirement strategy. Low interest rates make purchasing the underlying real estate, frankly, it makes it more affordable. If rents stay the same because of long-term leases, but the financial cost is lower because of low interest rates, then all things being equal, you can make a case that REITs have the potential to pay higher and higher dividends. That they're kind of like the rent of a non-traded asset. So as we discussed in the story of my friend, another benefit is that real estate has a strong tendency over periods of time to at least keep pace with inflation. Or in the case of the last 30 years in the chart we looked at a second ago, to way outpace inflation. And another really important concept here is that it moves differently than your typical bond and stock prices. They don't move exactly the same. Pretty compelling, huh? All right, good work today. Your future self is thanking you for educating your current self. You keep this up, you're gonna be a genius, or better yet, let us do the work. You go fishing or golfing or traveling, and we'll help you determine what strategies can help you either get on or stay on the right track. I think your future self is really excited about that.
If this information has been helpful to you, check out our other Telton's Tips videos, or better yet, call our office. You can talk to an advanced financial planning team member like me. Imagine that, a real life human that cares about you and your goals. My name is Caden Keller. I work here as a financial advisor along with Telton and the rest of the team. Here, we take a team approach to caring for our clients because we all know 2 heads are better than 1. So give our office a call, and I or anyone else on the team would be happy to answer a quick question for you or schedule a complimentary retirement planning meeting. There's also a link provided if you would like to learn more about who we are at Advanced Financial Planning or what it is we do for our clients in planning for their retirement. Lastly, the schedule an appointment link will bring up our calendar, and you can choose a time for a complimentary on the phone or an in-person retirement planning meeting. Whichever option you choose, the only mistake is to do nothing and keep working and putting retirement preparation off until you die at your desk. I've seen it time and time again. No matter how good and specialized Telton and I are, when people wait too long to seriously consider their retirement options, they're significantly set back and can damage their retirement. So call, schedule, or click to learn more. You've got nothing to lose, and your future self in retirement has a whole lot to gain.